Duke Energy has announced plans to merge its two North Carolina subsidiaries, Duke Energy Carolinas and Duke Energy Progress, with the aim of achieving significant cost savings for customers. The merger, pending regulatory approval from the NC Utilities Commission, the Public Service Commission of South Carolina, and the Federal Energy Regulatory Commission, is projected to save customers between $1.6 billion and $3.2 billion through 2038. The merger is expected to streamline operations, enhance grid reliability, and modernize infrastructure to meet the growing energy demands in the Carolinas. Despite assurances that retail rates will remain unchanged until 2027, there is skepticism about the long-term impact on customer bills and the environment. The announcement comes amidst the backdrop of the recent Power Bill Reduction Act, which has sparked controversy after the North Carolina General Assembly overrode Governor Josh Stein's veto. The bill repeals the state's interim emissions reduction target previously mandated for Duke Energy by 2030, a move criticized by environmental groups who argue it favors corporate interests over sustainable practices, while proponents claim the repeal will save consumers $15 billion. Studies from North Carolina State University and BW Research suggest potential long-term costs of $23 billion in additional fuel expenses and significant job losses. This legislative change, coupled with the proposed merger, highlights the ongoing debate between economic efficiency and environmental responsibility in the region's energy policy.
The recent implementation of tariffs under former President Donald Trump has introduced significant uncertainty into the U.S. and global economies, with potential long-term implications for growth. The tariffs, which affect a broad range of imports, are expected to slow U.S. GDP growth from its current rate of 3% to potentially as low as 1% over the coming years. This slowdown is attributed to increased costs for consumers and businesses, as well as disruptions in supply chains. The tariffs are leading to higher prices for imported goods, which reduces consumer purchasing power and may ultimately lower real wages. Additionally, small and medium-sized enterprises face challenges due to rising costs and supply chain disruptions, potentially impacting their hiring and investment decisions. The labor market has also been adversely affected, with the Bureau of Labor Statistics revising job growth figures downward by 258,000 for May and June. This has added to the Federal Reserve's dilemma as it navigates interest rate decisions amidst inflationary pressures and a weakening labor market. The tariffs' regressive impact on lower-income households who spend more on tradable goods further complicates the economic landscape. Uncertainty surrounding the tariffs is leading businesses and households to delay investment and consumption decisions, contributing to financial market volatility and diminished investor confidence. Globally, retaliatory tariffs could impact U.S. exports and slow economic growth in countries reliant on the U.S. market, exemplified by declines in Germany's industrial production. Key sectors such as manufacturing and automotive are particularly affected, facing increased costs due to tariffs on imported inputs like steel and aluminum.
Pensions UK has announced new retirement living standards, emphasizing that pensioners should be able to afford at least a one-week holiday in the UK annually. This initiative outlines 3 tiers of retirement lifestyles: minimum, moderate, and comfortable, each with specified annual expenditure estimates. For a minimum lifestyle, a single retiree needs approximately £13,400 annually, while a moderate lifestyle requires £31,700, and a comfortable lifestyle demands £43,900. These figures are based on the assumption that retirees own their homes outright, which can impact the overall cost of living. The standards aim to provide a realistic framework for future retirees to plan their savings and spending, acknowledging the importance of holidays for well-being and quality of life. Pensions UK highlights that with the full state pension and workplace pension auto-enrollment, achieving the minimum lifestyle is feasible for many. The standards are intended to help retirees maintain dignity and enjoy the lifestyle they worked for, despite rising living costs. This approach underscores the importance of financial planning and the role of pensions in securing a stable and enjoyable retirement.
Townscare Capital LLC has made a significant investment in OpFi Inc., NYSE OPFI, acquiring 55,440 shares valued at approximately $516,000 during the first quarter. This move is part of a broader trend among institutional investors, including Northern Trust Corp., which increased its stake by 23.1% in the previous quarter. OPFI, a specialty finance platform known for its credit access products like OPP loans and SalaryTap, has seen a surge in interest from hedge funds and institutional investors, who now own 7.10% of the company's stock. The company's stock opened at $10.42, with a market capitalization of $909.77 million and a notable beta of 1.71, indicating higher volatility compared to the broader market. OPFI's recent financial performance has been robust, with the company reporting an earnings per share (EPS) of 45 cents for the last quarter, surpassing analysts' expectations by 15 cents. Despite a negative net margin of 6.04%, OPFI achieved a positive return on equity of 53.83%, driven by revenue of $142.44 million. Analysts have responded positively, with several upgrading their ratings to buy or strong buy and setting an average price target of $13.63. This optimism is reflected in the company's strategic positioning and product offerings, which continue to attract investor interest. However, insider selling activity, including significant transactions by CFO Pamela D. Johnson and Director Theodore G. Schwartz, may raise questions about the company's future direction and internal sentiment.
Cisco Systems, Nasdaq CSCO, has experienced a series of upward revisions in its stock price targets from various financial analysts, reflecting growing confidence in the company's market position and performance. Barclays raised its target from $66 to $71 with an equal weight rating, while Wells Fargo and Company increased its target from $75 to $83, maintaining an overweight rating. Other firms, including UBS Group, J.P. Morgan Chase & Company, KeyCorp, Rosenblatt Securities, and Deutsche Bank have also adjusted their targets, with figures ranging from $73 to $87. Despite a hold rating from HSBC with a $69 target, the average target price for Cisco now stands at $74.53, suggesting a generally optimistic outlook. Cisco recently reported quarterly earnings of 99 cents per share, slightly exceeding the consensus estimate of 98 cents, with revenues of $14.67 billion, a 7.6% increase year-over-year. The company's strong financial metrics, including a market capitalization of $262.15 billion, a return on equity of 27.02%, and a net margin of 18.45%, underscore its robust financial health. The stock has shown strong performance, with a 52-week range between $47.85 and $72.55, and a price-to-earnings ratio of 25.27. Institutional investors, such as Norges Bank, DZ Bank AG, Vanguard Group, State Street Corp., the Ontario Teachers' Pension Plan Board, and Newedge Advisors LLC, have significantly increased their holdings in Cisco, indicating confidence in the company's future prospects. Cisco's strategic initiatives to expand its networking and IT solutions portfolio, particularly in areas like data center switching and enterprise routing, along with its consistent dividend payout of 41 cents per share, yielding 2.5%, enhance its appeal to both growth and income-focused investors. As Cisco continues to innovate and capture market share, the positive sentiment from analysts and institutional investors suggests a stable and promising outlook for the company's stock.
The Trader 1X Short Innovation Daily ETF, Nasdaq SARC, has experienced a dramatic surge in short interest, increasing by 249.2% in July. As of the end of the month, short interest reached 297,500 shares, compared to 85,200 shares on July 15th. This ETF aims to achieve the inverse daily performance of the ARK Innovation ETF, ARKK, using swap agreements with major financial institutions. The significant rise in short interest suggests a growing bearish sentiment among investors regarding SARK's future performance. The ETF opened at $32.41, with its stock price reflecting a 52-week range between $27.86 and $103.44. The current days-to-cover ratio stands at 0.7 days, indicating a relatively short time frame for short sellers to cover their positions based on the average daily trading volume of 400,500 shares. This heightened short interest may indicate market skepticism towards the underlying assets or strategies of the ARK Innovation ETF, which SARK inversely tracks. Such movements could impact market sentiment and influence investor strategies, particularly those engaged in thematic or innovation-focused investments.
ASML Holding NV, Nasdaq ASML, experienced a 1.3% decline in its share price, closing at $745.15, amid a significant drop in trading volume, which was 59% below its average. This movement comes despite a series of mixed analyst ratings, with Wells Fargo and Company raising their price target and maintaining an overweight rating, while DZ Bank and Jefferies Financial Group downgraded their ratings to hold. The semiconductor equipment manufacturer recently reported quarterly earnings of $4.55 per share, falling short of the consensus estimate of $5.94. However, its revenue rose 23.2% year-over-year to $8.94 billion, surpassing expectations. The company's market capitalization stands at $291.98 billion, with a P/E ratio of 30.97 and a beta of 1.76, indicating a higher volatility compared to the market. ASML has also increased its quarterly dividend to $1.856, reflecting a dividend yield of 1.0%, which may appeal to income-focused investors. Despite the earnings miss, the company maintains a strong financial position with a net margin of 26.95% and a return on equity of 49.47%. Institutional investors hold a significant stake in ASML, with notable increases in holdings during the second quarter, indicating continued confidence in the company's long-term prospects in the semiconductor industry.
Nebius Group, Nasdaq NBIS, experienced a notable 4.5% increase in its stock price, closing at $71.54, amid a surge of positive analyst ratings. The company's shares have been buoyed by recent upgrades from several research firms, including Arete Research, which elevated its rating to a strong buy and set a target price of $84. BWS Financial also raised its price target from $80 to $90, maintaining a buy rating. These optimistic evaluations come despite a 72% decline in trading volume compared to the average session, suggesting strong investor confidence in the company's future prospects. Nebius Group, a technology firm specializing in AI-driven solutions, reported a significant year-over-year revenue increase of 385%, although it posted a quarterly loss of 48 cents per share. The company's robust market capitalization of $16.88 billion and a P/E ratio of -125.65 reflect its growth potential and inherent risks. Institutional investors have demonstrated strong interest, with Orbis Allen Gray Limited and Invesco Limited increasing their holdings. The firm's strategic focus on AI, particularly through its Nebius AI and Toloka AI platforms, positions it well in the expanding AI and machine learning sector, potentially driving further stock appreciation and solidifying its market position.
Rigetti Computing, Nasdaq RGTI, experienced a 7.6% decline in its stock price, trading as low as $16.16 before closing at $16.61. This drop comes amidst a significant decrease in trading volume, with only 24.2 million shares changing hands compared to the average of 70.9 million. Despite the decline, the stock maintains a consensus buy rating from 6 investment analysts, with an average target price of $17.43. Analysts from B. Riley Williams Trading and Cantor Fitzgerald have issued positive ratings, suggesting a bullish outlook on Rigetti's potential, driven by its innovations in quantum computing. The company, which specializes in building quantum computers and superconducting quantum processors, has seen insider trading activity, with directors Michael S. Clifton and Ray O. Johnson selling shares at $15 each, reducing their holdings by 2.84% and 8.78% respectively. Institutional investors have shown increased interest, with notable inflows from IFP Advisors Inc. and Armstrong Advisory Group Inc., indicating a growing confidence in Rigetti's long-term prospects. The company's market cap stands at $4.83 billion, with a price-to-earnings ratio of -21.91, reflecting the speculative nature of investments in emerging technologies like quantum computing. Rigetti's stock performance is significant as it highlights the volatility and investor sentiment surrounding quantum computing firms. The company's ability to innovate and capture market share in the burgeoning quantum computing sector will be crucial for its future valuation. Insider sales could be perceived as a lack of confidence by some investors, but the strong institutional interest and positive analyst ratings suggest a more complex market sentiment. As Rigetti continues to develop its quantum computing capabilities, its stock remains a focal point for investors interested in cutting-edge technology and its potential to disrupt traditional computing paradigms.
Madison Square Garden Entertainment Corp. NYSE MSGE has seen a significant increase in institutional investment, with U.S. Bancorp raising its stake by a remarkable 2,273.6% in the first quarter. Other major investors such as Ariel Investments, LLC, and Jericho Capital Asset Management, LP, have also increased their holdings, indicating strong institutional confidence. Despite this, the company's recent financial performance showed a quarterly revenue decline of 17.2% year-over-year, with earnings per share (EPS) missing analyst expectations slightly at 50 cents compared to the anticipated 47 cents. On the analyst front, Madison Square Garden Entertainment has received mixed reviews. Morgan Stanley and Goldman Sachs have raised their price targets, reflecting some optimism about the company's future prospects. However, Wall Street Zen has downgraded the stock to a sell rating, highlighting concerns over its current valuation and financial health. The company faces challenges with a high debt-to-equity ratio of 60.61 and a notably negative return on equity of 458.14%, which could impact its long-term financial stability. Nevertheless, the stock maintains an average rating of moderate buy with a price target of $43, suggesting a cautiously optimistic outlook from the market.